So good afternoon again, Corina here from IIFL Securities, and we will talk about another type of investment, which is mutual funds, very, very popular in India. But before that, I would request ma'am to address the people. Ma'am, would you like to say a few words before we
I'm
start
not,
our...
taking out much of the time, but anyway, I would like to thank each one of you, because, I know it's a working day and it's quite a busy schedule for each one of us. Still, you have taken time to join our webinar today. And AMG Invest is endeavoring in providing such webinar sessions wherein the investors can have an idea and knowledge in such a way that they themselves can decide on the investment plethora, investment baskets. So right way of investing is what we are aiming at. And the financial services company, AMG Invest, is trying to give such valuable informative sessions in association with IIFL Securities. So anyway, we have with us the well-experienced Kunina Mukherjee. She's having more than 20 years of experience in financial sector. So I'm not taking much of your time, Kunina. You can just right away.
Yeah. Right. So thank you so much, ma'am, and welcome to our webinar. So I've started the screen share. I hope it's visible.
Yeah, it's
so we will just talk about some basics of mutual funds, how it is different from investing directly in stocks, and why we should consider this as why we should consider mutual funds in our portfolio for long-term financial planning. So we will start with some of the basics of mutual funds. See, what happens is when you invest in direct stocks, there are three things that are required to be successful if you want to invest in direct stocks and make money. Number one, you need to have money. Okay, because if you want to make money, you just can't invest in one stock. You have to invest in multiple companies, that is multiple stocks. That is number one. So you need a lot of money. Number two, you need to have the time. So you need to sit in front of the terminal right from 9:15 in the morning to 3:30 in the afternoon in order to find out what is the right time to buy the stock. And if you have stocks in your portfolio and if you want to book profits, then what is the right time to sell the stock? When I say right time to buy and right time to sell, what I mean to say is what is the right price at which I should enter the market and what is the right price at which I should quit the investment. That's something very, very important if you want to make money. Okay. Otherwise, you will find most people saying that जब मैंने खरीदने के बाद मैंने देखा price गिर गया. Okay. And when they sell off, you will say, I don't know. I just sell off the stocks and the prices keep going up. You will find most people saying this, that, I buy high. The moment I buy, the prices fall. And the moment I sell, the prices go up. That is because they're entering at the wrong time and quitting at the wrong time. That is because probably they are following, the people in the market, something that is known as herd behavior. So I follow the herd. I follow people before me. I don't think, I don't analyze, but I just follow the people before me. So, when the prices are going up in the market, investors are entering the market. So I think, chalo, market बढ़ रहा है, अभी मुझे भी घुसना चाहिए. I buy at a high price, and when the market falls, when people are quitting, I think I've had enough. So I should quit now, and I quit at the wrong price. So that is where people lose. The third thing that you need is the knowledge. So these are three things that are a must if you want to invest in direct stocks. That's time, money, and you need to have your knowledge. These are the three things. Now, 99% of the population will lack that. Believe me, people who say that I understand the stock market, I know everything, actually know nothing. They think they know everything, but they actually know nothing. The reason being, had it been so, you would have had Rakesh Jhunjhunwala's lying here and there. Every family would have had a Rakesh Jhunjhunwala if people understood stocks. It's not so. It's not easy. It requires years of study. It requires research. You really have to, burn a lot of midnight oil if you want to become an expert in the stock market. Now, for us, that's not possible because we are all busy with our own professions. So, giving time to your profession and then taking time out and studying the stock market, believe me, no easy job. Most people cannot do it. Okay. So the other way that we have where you can take advantage of the market at the same time, take a very, very calculated amount of risk is through mutual funds. So what's a mutual fund basically? So mutual fund is nothing but It is a pool of money where investors like you, me, we have all put our money. Say, there's a big pond, okay, no water, but there's a big pond. So all of us put in our money over there. So somebody puts in 5,000, somebody maybe puts in 50,000, another person puts in 10 lakhs. So whatever is our capacity, so we put all our money into this pool, okay, this empty pool, till this pool becomes full. So when this pool becomes full, it's full of money, the total amount of money that is lying in the pool will be a lot. Maybe, a few thousand crores, maybe 3,000 crores. Okay, because so many investors have put in their money into this pool. So now what do all of us do? So we have 3,000 crores lying in that big pool. Call an expert, call a person who's an expert in the stock expert, who has expertise on the stock market. So he knows where to invest this money. So we say, Bhaiya, you understand stocks. Take this 3,000 crores and you invest in different companies. Now, what's the advantage? Had I invested alone, I could have never been able to invest 3,000 crores, isn't it? I don't have so much of money. At the most, how much would I have invested? 1 lakh, 2 lakh, 10 lakhs. Okay. Super HNI person maybe would invest 1 crore. But even that is not enough. Okay, even that is not enough, because you have to choose a number of companies and you also have to choose a certain number of shares in order to, uh, take the benefit of volume. तो ये बहुत सारा calculation होता है. तो अकेले हमारे लिए ये possible नहीं है. But just because so many of us have put in all our money and now that entire pool has become around 3,000 crores, the fund manager, the expert, he's called a fund manager because he'll be managing our funds. He takes it to the stock market. He takes this money to the stock market and he invests it. So all investors, we give our money to the fund manager. The fund manager now will use his expertise to select the stocks. And since he has got 3,000 crores to invest, so he can invest in a lot of stocks, maybe 100 different stocks. So what happens is, when you invest in 100 different stocks, you are actually bringing down the risk of the investment. How? Because if the market goes down, it will never happen that all these 100 funds will go down together. All these 100 stocks will go down together. So maybe if 60 of them have gone down, 40 of them will still be up. Or if 60 have gone up, maybe 40 are down. So, there's this balancing which happens. हाँ, इस बैलेंस को सीधा रखने के लिए the fund manager will use his expertise. कभी ऐसा नहीं होगा that 10 stocks are up and 90 are down. ऐसा नहीं होगा. Because there's competition in the market also. The fund manager, he will also have to prove his mettle. Otherwise, the fund houses will throw him out. So, there's always this balance. वो 60, 40 या 55, 45 उसका एक balance रहता है. और ये balance इसीलिए possible है because I have chosen some 100 different stocks in the portfolio, which had I invested alone would have not been possible. So what is the benefit that you are getting over here? You are getting the benefit of expert advice, even if your individual investment is only 5,000 rupees. So can you imagine? I've only invested 5,000 rupees, but I have taken the benefit of expert advice just because I have invested in a pool along with other people. So for the fund manager, it is still beneficial. He still makes money because he's not investing your 5,000 rupees alone. He's managing the entire pool. And for you, you get this benefit of expert advice even by investing 5,000, 50,000, whatever, which otherwise would have not been possible. So even if you had invested, 1 crore, it will be difficult to get an individual fund manager to manage your fund. Nobody will do it. Okay. So that is the advantage of mutual fund. One is you can choose any amount of investment that you want, starting from 5,000 to 50,000 to 5 crores, anything. You get the benefit of expert advice at a very, very reasonable cost, which alone you will not be able to do. And believe me, none of us have the expertise of the fund manager. So if you think, I can see the portfolio of the mutual fund over the internet, and then likewise, I will do my investments. You never know when the fund manager is balancing the portfolio. You don't know that. You may not have that updated information on the internet, on the web. So, some of our clients say, koi baat nahi, I will check the portfolio from the internet and I will invest accordingly. I will also select those 100 stocks and invest. But that's just one part of it. When to rebalance, when to sell off a stock and pick something else in its place. All that information will not always be updated on the net. So you can never compete with the expertise that a fund manager has, because that's all he's doing throughout the day. That's his job. Okay. So you get all these benefits through a mutual fund. Now, when this pool of money makes profits, the profits are again distributed amongst the unit holders, as they are called. The investors in this case are called unit holders. The profit is distributed to them in the proportion in which they have invested. Another advantage of mutual funds is that anyone can invest in mutual funds. So whether you are an individual, or you are a part of a HUF, or if you have your own partnership firm, or if you are a NRI, anyone can invest over here. Okay, this is one. The second the other advantage of investing in mutual funds is that you have a lot of different ideas to choose from. So your risk taking appetite will vary. So there's something, called a risk attitude and a risk aptitude. That's what I was, ma'am and me, we were discussing, before we started the webinar, that even if I have a lot of money, I may not have the nerve to take additional risk. So I have the aptitude, I have the capability, but my reaction towards risk is very, very conservative. The reverse can also happen. We know a lot of clients who do not have much money to invest. Even then, he is ready to take the risk in order to earn higher returns. Okay, so two things to see when you make your investment. One is, what is your attitude towards risk, and what is your aptitude. So aptitude is actually something which is measurable. So, I have a lot of savings, or I have a lot of family property, which is worth a couple of crores. So I can always take a risk on a crore. I can do that, but my heart will not allow me to do that. So that means my attitude towards risk is very, very conservative. Keeping all these things in mind, you have different types of mutual funds available in the market to suit your attitude as well as aptitude. Okay, so what you have to do is, you just have to check something called the mutual fund objective. Every mutual fund comes with an objective, and mutual funds, let me show you this slide first. There's something called an offer document. Okay, so every scheme has an offer document. In that offer document, the objective of the mutual fund, where it is going to invest, in what type of companies, all those things are defined. So from there, you can understand what type of risk this fund is exposing itself to. So is this an aggressive fund? Aggressive fund in the sense it is taking a higher amount of risk, or is it not so aggressive a fund? So probably meant for conservative investors who do not want to risk their capital, but yes, all they are looking at is uh, uh, maybe 1 or 2% higher return than the traditional fixed deposits or post office deposits. So you have everything specified in the offer document. So before actually investing in a mutual fund, if you can understand, and if you can go through the offer document, of course, the offer document is pretty long. It's quite a few pages with all technical terms. So again, not advisable that you go through the offer document, because unless you are very well versed with the financial market, you will not even understand 10% of what is written in the offer document. But yes, everything is mentioned over here. So you have a scheme for everyone, for all types of risk taking. I mean, all different types of risk attitudes and aptitudes. So some of the advantages of mutual funds are, you can actually achieve what is known as diversification. Diversification means something like, don't put your eggs into one basket. So if you have 100 eggs, if you distribute it amongst different baskets, you will find that, the risk that you take on each basket is less. So many पूरा eggs एक ही basket में डाल दिया, and I drop the basket from my hand, all the eggs will break. But if I spread it across different baskets, then what I do is, I'm spreading my risk. That is something called portfolio diversification. How do we achieve portfolio diversification when it comes to investments? You don't invest in the same avenue, or you don't invest in the same scheme. That is possible through mutual funds at a very, very low cost. And I told you why, because the fund manager is not being employed by you. You are not paying him individually, but all the people who have contributed in the pool, they will be paying. You get the advantage of professional fund management, very, very high flexibility. So if I buy mutual funds today, I can also sell it off after 7 days. Okay, so most of the mutual funds come without a lock-in, unless it's a tax saver mutual fund where there is a lock-in period of 3 years. So very, very flexible. It's a highly regulated industry. So SEBI, which is the Security and Exchange Board of India, along with AMFI. AMFI is also a regulatory body which regulates mutual funds. It's Association of Mutual Funds in India. So SEBI and AMFI together have set rules to manage the mutual fund industry. So highly regulated industry to protect investors' interest. So the fund manager cannot afford to go wrong. Whatever the fund manager does is always under scrutiny. Okay, so that is why the investors' interests are protected. You get tax advantage over here in the sense that there are certain mutual funds where if you invest, you get the benefit of ATC, the same tax benefit which you get when you buy life insurance or those kind of products. At the same time, when your mutual funds mature, you pay capital gains tax on your profit or on your gains, which is again much less than the interest that you pay on your fixed on the which is much less than the tax that you pay on the interest that you earn from fixed deposits or post office deposits. So what happens is, when your interest income is taxed, it is taxed as income from other sources. So when you file your return, you will find that whatever income you've got in the form of interest will be shown under income from other sources. So when you show this income as income from other sources, your total income goes up. So your gross income goes up, as a result of which this interest income is taxed in the slab in which you are in. So if you're in the 30% slab, your interest income will also be taxed at 30%. But when it comes to capital gains taxes is flat for everyone. So if it's long-term capital gains in equity, it is flat 10% for everyone over and above a capital gain of 1 lakh. So there is this flat rate of 10% for everyone. So whether you are a millionaire, whether I'm a pauper, capital gains tax for you and me will be the same. It doesn't depend on my tax slab. So tax efficiency is here. And I've also told you about liquidity, that if I invest today and I want to withdraw after 7 days, I can do that. So you can withdraw your money anytime. So that liquidity is also there. So we were here. So I was talking to you about the offer document. So just moving ahead, there are different types of mutual funds. And as I said, you can classify mutual funds according to structure. So some mutual funds are called open-ended. Open-ended in the sense you can enter anytime and you can quit anytime. You can invest anytime and you can quit your investments anytime. There are close-ended funds. So there's a period during which you can invest. After that, the fund is closed for subscription. Okay. There are interval funds, which are basically a combination of open-ended and close-ended funds. You can have mutual funds according to the investment objectives. Some funds may aim at growing the capital, which are called growth funds. Some funds aim at giving a regular income in the form of dividends. So they are called dividend funds. You have balance funds, basically a mixture of your equity and debt schemes. So various different types of funds depending upon the investment objective. And you also have, you can also classify mutual funds according to the theme. So you may have tax saving funds. So the purpose of these funds are to save taxes. You may have your thematic funds. Okay, so theme could be something like an infrastructure fund. So what are the companies which are involved in infrastructural development of the country? So maybe cement, maybe iron and steel. When you build, buildings, or when a construction is made, you need electrical wiring. So, companies building cables, or companies which are related to power, like Power Grid Corporation of India. All these things, all these companies will get business. So when there is growth in infrastructure. So, a theme like infrastructure fund will try and invest in companies which are related to the infrastructural development of the country. Okay, things like that. So again, another theme could be healthcare. So when it comes to healthcare, you will find hospitals being involved. You will find that pharmaceutical companies being there. So all these things like that. So you have these thematic funds. Again, we need to understand that, because you really have to do a lot of studies in order to become experts over here. So a lot of study is required. So I just thought I will tell you all these things in brief. However, you will hear these terms whenever it comes to investments, and we always want to know before we do an investment, because we want to make an informed decision. So that is the reason why I thought I should tell you. However, always speak to an expert before you arrive at a decision. Try and understand why the expert is recommending you the funds. Try and understand whether your investment objective is being met through this investment. That only an expert can tell you, because as I said, it is very, very important to balance the risk attitude and the risk aptitude of a person. Never follow investment advice from a friend unless he or she is an expert. So if somebody tells you, I've invested here and I've earned good returns, please remember the term good, bad is relative. What is good for you may not be good for me. So if you tell me I've got a 12%, I'm very happy with it. Believe me, I'll be extremely unhappy, because I'll be looking at 18%. I'll be looking at 22%. So what is good for you may not be good for me. What is bad for you may not be bad for me. So 12% is bad for me. 12% may be very good for you. So that's the reason why I say don't follow the investment structure of a friend or a relative, because that suits his investment appetite. It may not be suitable for you. इंडिया में क्या होता है, ज्यादातर इन्वेस्टमेंट्स या इन्वेस्टमेंट एडवाइस हम लोग फ्रेंड्स से लेते हैं. So my friend made good money here, so I'm also going to do it. Please do not do that. The reason is your friend has a different attitude, has a different risk aptitude, may have a different requirement altogether. Okay, you don't know all that. You just know that he's made profit. But his risk attitude may not suit yours. His risk aptitude may be very different from yours. So all these things matter, and all these things can only be taken into account by an expert before he suggests an investment to you. So always stick to an expert. Another thing that I think I must mention over here is, please don't go by free advice. Okay, lot of people around, lot of companies around, lot of organizations around will say that, we give advice for free. This service is for free. Now tell me something. If your interests are important to him, why will he give free advice? Why will I give free advice when I am earning nothing out of it? So yes, free advice is available, but that's some general advice, for everyone. So it is something like I say, you must have fruits in the morning. So that's a general advice to all of you, but which fruit? So see, I'm diabetic. I can't have bananas. Okay. I can have apples, but bananas may be good for you because they're rich in iron. So see, I gave a general advice. You can have fruits, but what? Which fruit is good for you? Which fruit is not good for me? That doesn't come through free advice. So free advice will tell you have fruits, have vegetables. That's free advice. But which fruit, which vegetable do I require? In what portions? That will not come from free advice. So do not fall to these traps. Okay. So if you want advice which is specifically for you, at times you may have to pay a fee. You may have to pay. So I'm not saying कि आपको देना ही है. मैंने ऐसे ही बोल दिया है because we get very attracted with whatever is available free. So buy one get one free. You will find people going and crowding over there in order to buy. But tell me something: if the other party is not making profit, why should they give you something for free? And if they are giving you something for free, what's the interest? So that is something you need to look at. So again, moving on. So when it comes to selecting mutual funds, look at your investment objective. So do you want capital preservation? That is, my investment should be safe. However, I just want to earn interest, which is a couple of notches more than savings account interest or your PPF or your fixed deposit. Do you want investment which will generate income for you? Or do you want an investment for the sake of capital appreciation? So I want to invest because I want to make my money grow. That's capital appreciation. So for that, again, we have different types of funds. So as I said, it totally depends upon your financial goal. What is the reason behind the investment? So is it money for your retirement? Is it money for your children's higher education? Is it money just for wealth creation? So what's your financial goal attached to the investment? And of course, your risk tolerance. So what is the amount of risk that you are able to tolerate? How much risk can you take? Okay, so all these things will depend upon, I mean, all these things will influence your choice of the fund. So again, you have different types of fund management. Some are passive funds, which generally follow the index, that is either BSE, NSE, the Sensex, or your Nifty. So passively managed because you don't have to spend much time over here, because you just need to follow the index. Okay. The other is actively managed funds, where the fund manager will use his discretion to manage the fund. Anyway, not important for you, but you hear these terms when it comes to mutual funds. So I thought I should just mention this. So just let me tell you about the tax saving schemes and what are the benefits of investing in tax saving schemes. So tax saving mutual funds are called ELSS, equity linked saving schemes. However, they come with a lock-in period of 3 years. But I would like to tell you that these schemes, let me show you this one, these schemes, the ELSS, or the equity linked saving schemes of mutual funds, they have the shortest lock-in periods. So any tax saving scheme which is available in the market, like your fixed deposits or insurance or PPF, they all come with a lock-in. So tax saving bonds or tax saving fixed deposits in a bank, they have a lock-in period of 5 years. Life insurance policies, they have a lock-in period of 5 years. PPF has a lock-in period of 15 years. However, partial withdrawal is available from the 6th year onwards, but they have a lock-in period of 15 years. NSC, that also has a lock-in period. Okay. So see, your tax saving mutual funds have the shortest lock-in of 3 years, and whatever returns you get are taxed as capital gains. So whatever gains you make are called capital gains, because these investments are in the capital market. Capital gains have a flat rate of taxation for all. So whether you are in the 30% bracket, or whether you're in a 20% bracket, or whatever bracket you are in, there is a flat rate of tax for everyone. Okay. So you have the tax advantage over here, that you pay a flat rate. It is not according to your marginal tax slab. So that's the big advantage over here. The other thing is that, remember this, this is, a survey which was, I think, done by Economic Times, and there were some around 2,200 people who participated in the survey. And this is what came out of it. People think that the interest that you get in FD is tax-free. It's not so. I just told you that interest income is taxed under income from other sources in the marginal tax rate. Then some people thought that, again, interest earned on infrastructure bonds is not taxable. Just remember, interest is taxable except in PPF. Okay, except in PPF, all other interest income is taxable. Even the interest that you get in NSC, the interest that you get in tax saving fixed deposit, you have to pay income tax on it. So interest income is always taxable except for PPF. But the survey revealed that people thought that you don't have to pay any tax on interest income. This is a real survey. And you could have escaped taxes a couple of years ago, not now. You can't escape taxes, because your PAN and Aadhaar are all linked, and the income tax department knows about it. Believe me, I've worked in a bank. Any transaction that is done in the bank, any high value transaction, has to be reported. Okay, so even if you don't reveal, the bank is going to give the intimation to the income tax department, so they know what type of interest income you have added. And interest income is taxed based on accrual. You may not have realized the interest, You may not have taken out the interest from the account, but the moment the interest accrues in your account, you are liable to pay tax. So there are a lot of things which we need to know. If you have a tax advisor or a tax consultant, speak to your tax consultant. They'll tell you more. But this is, the truth which was revealed through the survey, that people don't even know on what you pay tax and on what you do not pay tax. So when it comes to tax saving, do consider mutual funds. Number one, shortest lock-in. Number two is you get the benefit of capital gains. Then what I would like to tell you is what are some of the portfolios that we suggest. So AMG Invest, in association with IIFL, we have our very well research portfolios coming. So I'm just stopping the screen share. Let me show you just one of the research reports that we circulate at IIFL to our investors. Okay. This report comes in monthly. So this is just one of the research reports. Okay. So we have various research reports which we give to our clients. In case you're interested, it's available. You can read through it. Otherwise, of course, you have ma'am. Okay. So ma'am can do this work for you. But we have these research reports which are available to clients. So see, these are, this report is circulated monthly, just one of the reports. This is called an investment strategy report. So in the current month, what are the mutual funds that we are suggesting? Those suggestions are given over here. So I am sharing with you the investment strategy report for March. I have not yet received the investment strategy report for April, should come in any time. So this is the last month's investment strategy report. So it tells us about the different types of funds that we are recommending in the large cap segment, in the focused fund segment, in the value propositions. Okay, if you want to invest in the mid cap or the small cap segment, what are the funds where you can invest, and the fund details. That is, what is the AUM, what has been the return in 1 year, 3 year, or 5 years, large cap, mid cap, small cap. Okay, what is the asset allocation? So that is a total pool of money that is there with the fund manager. What portion of that pool he has invested in large cap, mid cap, or small cap? All the details are given over here. It also says the recommended period for which you should stay invested. Please note, mutual funds are for long term. If you really want to make money, if you really want to build wealth. However, you have the option of quitting the investment anytime. So that's the flexibility. Okay, right? So these are some of the funds that we have recommended. So you have more coming. So these are some of the debt schemes that we have recommended. Debt schemes matlab aapka return kuch like it will be in single digits. It's a debt scheme. However, your capital will be very safe. So even if the market falls, even if there's volatility in the market, there won't be much of a fluctuation in your fund value. However, we also have something called model portfolios. So this is something I would request you to look at. So maybe ma'am can speak to all of you individually, check your risk profile, and you can suggest these portfolios. So see, we have 5 types of portfolios here at IIFL. Very, very well researched idea. So we have this portfolio, which is for very conservative risk takers. Very conservative risk takers are those investors who are not even ready to risk 1 rupee of their investment. So if you have invested 1 lakh, your 1 lakh should remain 1 lakh. It should never fall to 99,999. However, you will be happy with single digit returns. So that is a very, very conservative risk profile. Now, if you say then, why shouldn't a person go for fixed deposits? Why should a very conservative risk taker come to this portfolio? The reason is he will get the benefit of capital gains. That's the reason. Okay. So if you have earned interest of 7% from your fixed deposit, and if you're in the 30% tax slab, you pay 30% of the 7% as tax. So that is 2.1%. So your net return after tax is going to come down to how much? 7% minus 2.9%, 2.1%. How much? It will come to 4.9, right? So your net return after adjusting taxes actually comes to 4.9% because you have had to pay a 30% tax on your interest. However, Had it been capital gains, you'll pay a flat 10%. That too, if your profit is above 1 lakh. So whatever you have received over and above 1 lakh, you pay a flat 10%. So if you have if your 1 lakh, if it has become 2 lakhs also, even if it has doubled, you will still not have to pay any tax on it. Why? Because 1 lakh पर आपको 2 लाख मिला, आपका gain हुआ है 1 lakh, but you only pay tax over and above 1 lakh. So see, there are certain advantages. Okay, so that's the reason why very conservative risk takers may want to choose this portfolio. So we have recommended these 5 funds, these 5 different mutual fund schemes, and this portfolio is only made up of mutual fund schemes. Okay, where the percentage allocation is also given over here. So if you give me 100 rupees to invest, I will break this 100 rupees into 20 rupees, 15 rupees, 20, 25, 20, and I'm going to invest it in these different funds. So I'm diversifying your portfolio. I'm not putting all your investment into one scheme. I'm not putting your investment into one basket. So I'm spreading it across 5 different mutual fund schemes so that you get the best of returns. Okay, right? Then I have another portfolio over here, which is called conservative risk profile. So the difference between very conservative and conservative is conservative risk profile may take some amount of risk. So if you tell me, ma'am, your 100 rupees may become 98 rupees, but you will also be able to earn good returns. So I may say, ठीक है, चलो 2 रुपए का risk में ले सकता हूँ, 2% का risk ले सकता हूँ. But very conservative risk profile people will say, no, my 100 rupees must be 100 rupees. That should never erode. So that's the difference. थोड़ा सा risk taking capacity में difference होता है. So conservative risk profile को भी हम 5 different funds recommend कर रहे हैं in this proportion. Right? The objective of each profile is given over here. So see, you can actually read the objective of the fund. If it matches yours, then this profile is right for you. So this was the second one. The third profile that we have is for moderate risk takers. Again, 5 different funds in this proportion. The strategy and the objective of the fund is given over here. You can again go through it. If your risk-taking capacity matches the fund, if your investment objective matches the fund, then you can very comfortably invest over here. So these are long-term investments. So it's better if you can stay invested for a period of 7 to 10 years in order to earn a good return. But believe me, you at the end of the day, you will be very satisfied with all this. So maybe we can have a session on financial mathematics sometime, where I will actually show you that how time has a big effect on your investment. So, if you can just hold on to an investment maybe for 3 years more, you don't know what kind of extra returns you can earn. I'll not be able to show that to you just now because I need to use Excel, but it's worthwhile. So, at times, maybe I can hold on to the investment, but then I think, why should I? What difference is it going to make? But believe me, even a period of 3 years will make a lot of difference to your returns. So time is the biggest factor which influences your investments. It's not the interest rate, it's time. Okay, so these are long-term propositions. So if you have time of anything between 5 to 10 years, you can very easily choose these portfolios. So these are our recommendations. Recommendations may not be the same next month, depending upon market conditions, depending upon your scheme performance. However, the name will be the same. So you will still be a moderate risk profile, but we will change these funds. These schemes over here can be changed. So if you are investing today as a moderate risk taker, we will suggest these funds to you. If you are investing 2 months hence, maybe some of the funds will change over here. It can happen that way. So this was the third one. The fourth one that we have is aggressive risk profile. Aggressive risk profile is again for investors who are willing to take high risk on their investment. So what I mean by high risk, so 100 rupees I invest, I am willing to take risk of up to 20%, which means even if my 100 rupees falls to 80 rupees, I'll be all right. Okay, so that's an aggressive risk profile. But however, I am willing to take a 20% risk in order to earn a 15% return. So kabhi kabhi ho sakta hai, because of market conditions, my 100 rupees may fall to 80 rupees. I'll still be comfortable, but I will wait for my money to grow from 100 rupees to maybe 115 rupees or 120 rupees. For that, I'm willing to take the risk. Willing to take the risk does not mean that you will realize the risk. Please remember, unless you book your loss, it's always a notional loss. So market has fallen, my portfolio value has come down. You will not make losses till you book the loss. Okay. So हाँ loss हो रहा है, you have to wait for this period to be over. So you know you will have to write this fall. You have to wait. You don't make losses till you book your losses. So it's only a notional loss. Okay. So that's what is meant by aggressive risk profile. And the fifth profile that I have is a very aggressive risk profile. So these people are willing to take very high risk. So maybe if you tell me, Konina, your 100 rupees may fall to 60 rupees sometimes. But if you're willing to take the risk, I can assure you that you can earn returns between 15 to 20%. So I may say, yes, okay. At times I have to take the risk. I need to ride over this downfall. So I need to wait. So that's again the secret of success in the stock market. If the market is down, don't panic, hold on, just hold on, because this time will be over. There will be a time when the market will bounce back, and that is when you're going to make money. People make book losses because they quit the market at the wrong time. Okay. So fear is the biggest factor which makes people book losses, and greed is again the biggest factor which makes people invest at a high value. So these are the two things which work in the share market. Fear and greed, both are required, but when to fear and when to be greedy, that is very, very important. That only the expert can tell you. So I'll be greedy when the others are fearful. So when the others are selling desperately and the market is falling, I'll be very greedy because this is the right time to buy. Prices are low. I will get at a lower valuation. And I'll be fearful when the market has gone up because I know that there will be saturation after some time. Okay, there will be less buyers and more sellers, and the market will come crashing down. So when the market is at the top, I would like to sell. And when the market is at its low, I would like to buy. So remember, two things work in the market. One is fear, one is greed. Okay. But when to be fearful and when to be greedy, that is something only ma'am can tell you. Okay. Because she knows. So these are the 5 profiles that we have. So what we do is we check your investment objective. What do you want? How much risk you're willing to take? What is the time that you have in hand? And based on that, we suggest these profiles. So this is just one of the reports that I've shown to you. There are various other reports that are circulated at IIFL. Okay, but this is just one of the reports that I've spoken to you about. This report is also, you can see it's of around 46 pages. So most of the people will not have the time to read the report, and this is exactly what happens. All research reports are made available to clients, but you are busy with your work, you are busy with your own profession, so you don't get the time to go through these reports. So in order to understand the reports, the kind of time that you have to spend on these reports, you don't have that. So that is why we always say, come to the expert, because we are dealing with this all the time. So see, today in this webinar, I addressed this report. Then I think 2 days ago also, there was a training with our investment advisors like ma'am. So I was explaining the report to them. So I work with this report every day. I'm having a look at this report every day. So even if the report is not open in front of me, I'll be able to tell you what are the different schemes that have been advised in the moderate risk profile. So I am naturally in a better position to address people, to advise people, because I'm dealing with this all day. This is my work. But you can't expect that confidence, okay, or that fluency with a person who just opens this report, once in a month to see what the suggestions have been made over here. So this is our job. This is our job. Leave it to us. Right? So as I said, a lot of research reports are there. You can always take some time off from your schedule, speak to ma'am. She will share the details with you. Again, which scheme is right for you, which profile is right for you, that is only something an expert can decide. Unless you are dealing with the stock market all the time, you will not be in a position to understand. So please don't think that, this is very simple. I can just read and I can just talk to people and I can understand what is the right type of investment. Believe me, this requires expertise, right? So this is what I had from my end. I'm stopping the screen share. If you have any questions, you can ask.
Yes, Karina, they have mentioned few questions in the chat
Okay,
box. Like,
okay,
just take up.
right.
Please repeat about the tax benefits.
Okay. See, there are two types of tax benefits that you can get from here. One is the tax benefit on the investment amount So very similar to the tax benefits that you get when you invest in life insurance. So that tax benefit of 1,50,000 per PAN per year on the investment. The same benefit can be, you can get the same benefit by investing in ELSS mutual funds. So you can invest to the tune of, you can invest any amount, but the tax benefit will be calculated on an investment of 1,50,000. So ELSS schemes give you tax benefits under Section 80C of Income Tax Act to the tune of 1,50,000 per PAN per year. Every financial year, you can take this advantage. 1,50,000 of investment made here will be deducted from your taxable income. So if you are earning 10 lakhs, and if you have made an investment of 1,50,000 in ELSS, your 1,50,000 will be deducted from 10 lakhs, and the remaining amount, 8,50,000, will be taxed as per your slab, right? This is one benefit. The other benefit that you can get is the benefit of capital gains on the returns that you get. So say, for example, you had invested 1 lakh. That 1 lakh has become, say, 2 lakhs. So you have made a capital gains of 1 lakh on your investment of 1 lakh. So to you, your investment has doubled.
Yeah.
Okay. But 1 lakh will be treated as capital gains. And the best part of capital gains is that if it's equity mutual funds, you will have to pay a flat 10% on your capital gains, which are over and above 1 lakh. तो 1 लाख तक का प्रॉफिट पर आपको कोई टैक्स नहीं देना पड़ेगा. 1 लाख के ऊपर आपका जो रिटर्न आएगा उस पर आपको फ्लैट 10% देना पड़ेगा. बट इमेजिन इफ 1 lakh had come through interest income. तो you invested 1 lakh, your return is 2 lakhs. मतलब आपने 1 लाख का प्रॉफिट बनाया. Had this come through interest, on that 1 lakh you would have had to pay maybe 30% tax. That is 30,000 rupees would have gone as tax. But since it is capital gains, you don't have to pay capital gains tax on the first 1 lakh of gains. Above that, you pay a flat 10%. So a flat rate hota hai sabke liye. Even if you're in the 30% slab, you will pay 10%. So that's the other advantage. So two advantages. One is on the gains. The other is on the investment amount under Section 80C, where every year you can claim a tax benefit of 1,50,000 rupees on your investment. So these are the two benefits of taxes. The other question is, which is the good option to earn good interest on investment of 90,000? Shilpa ji, I think ma'am can take this. Yeah, she can have a talk with you.
Yeah, we need to sit together.
Yes, absolutely, absolutely.
Based on that, we can work out different options.
Yes. Yeah. There's another question. Okay.
I think that's it.
That's it. If you have any questions, you can ask. We still have around, I can still spare another 10 minutes. So you can ask me anything you want to know.
Actually, I have a question. I think your session was very simple and informative. So thank you. Actually, I'm an illiterate. I'm sad to say this at this age, but I'm.
Ma'am, it's okay. This may not be your subject. You may be an expert in your own line. So it's absolutely okay, ma'am. So it's, something like if you ask me something about medicine, I may not know that. That doesn't mean I'm illiterate. That's not my subject. So it's absolutely okay. It's absolutely okay.
I think you're on mute.
No, I'm not on mute.
I'm on mute. I was on mute.
Okay.
The good thing is there is no age to learn. So here I am learning and interested.
That's great. That's great.
I just want to ask about ULIP schemes because, this last up to March end, there was this race against time with my two banks, HDFC, Axis Bank, chasing me down till March 31st. The pressure was intense. trying to get me to invest in ULIP schemes,
ULIPs.
all max life insurance and all those. So I've already done a mutual fund, which is a ULIP. But other than that, I'm interested to get out of the ULIP scheme thing. Like, how many life insurances can you take? So what is the difference?
Ma'am, first of all, banks will always pressurize you to go for ULIPs. I'll tell you why. Because they have a target to sell life insurance. But what happens, ULIP is not bad, but too many ULIPs will really not do you any good, because unnecessarily you will be paying fund management charges. You will be paying premium allocation charges. Okay, the more number of policies you have, the more charges you will pay. So mutual funds that way will be, cost efficient. So banks will always do that, ma'am. They will look at their own interest. That is why I said free advice is not always good. So banks will always say, free में आता है ये, हम लोग ऐसे ही financial planning करके देते. It's not bad. I've been in a bank, even I've done that. So if you have the target pressure and not very many products to offer, so if I'm only given ULIPs to push, I will only push ULIPs. Okay, but you may have other alternatives over here. So again, for ULIPs, if you say you want to quit, number one, you have to continue any ULIP policy for 5 years.
Yeah.
Okay, because if you discontinue any ULIP policy before 5 years, your money moves to the discontinued policy fund.
Is it minimum 5 years?
Yes. Yes.
Okay.
It's minimum 5 years. You cannot quit before 5 years. If you quit, if you stop paying your premium, even then you will not receive your proceeds, because your policy money will move to some a different fund, which is called a discontinued policy fund. That's a rule. That's an IRDAI rule, that the money will move to the discontinued policy fund, where all ULIP policies which have been discontinued, the fund is taken and it's put in a separate fund, which is called a discontinued policy fund. Your money will stay there till you complete 5 years, and then you get back that amount with a very minimum amount of interest. But however, before your money moves to the discontinued policy fund, because you've stopped paying the premium, you will have to pay what is called surrender charge. Okay, so your money really doesn't grow in the discontinued policy fund. You kind of recover maybe about 70% maximum of what you have paid. So it's not a good idea to quit any ULIP policy if you have already invested over there. So I would suggest continue for 5 years. Otherwise you book losses, right? This is number one. Number two, if you want to take the benefit of mutual funds, go the direct mutual fund way. So invest in mutual fund schemes. If you have any insurance requirement, go for term plans. Go for term insurance plans. That's the best option and the most cost-effective way, where your investment needs will also be taken care of and your protection needs will also be taken care of. You will find that banks will not push term policies.
No, they don't.
That's because they don't make commission out of it.
Yeah.
Okay. So they will try and push ULIPs. They will try and show you good returns and they will push ULIPs. Again, as I said, nothing wrong, but they don't have any other products. So if you come to me, I have mutual funds, I have PMSs, I have this, I have that. I can give you 100 different products depending upon your risk appetite. So this is something that you need to look at. So have a look at your ULIP policies, see how much time you have completed over there. Quit the scheme once you have completed 5 years, not before that, because you lose money.
Okay, that helps. Thank you so much.
Thank you.
Hello, ma'am.
Yes, Shilpa, tell me.
Yeah, I have one question. As you worked earlier in bank, as you said,
Yes.
so I want to know if I sell home property and if the amount is deposited in a bank, so how much amount can be deposited in a bank?
Okay. You can deposit any amount in a bank. Okay. There's no limit to the amount you can deposit in a bank. However, your sale of house property will attract capital gains. But there is the benefit of indexation that you can take on sale of any property. However, you will have to pay capital gains taxes. The other way in which you can save taxes is if you invest this amount of money, but that's also to the tune of 50 lakhs in, your 54 EC bonds. So whatever proceeds you have got from the sale of your house property, up to 50 lakhs can be invested in what is known as 54 EC bonds. But the rest of the money will have to be taxed. But your 54 EC bonds do not pay you much interest because these are government bonds. However, the government encourages you to invest in these bonds because you can save taxes on your capital gains. That's it, right? So, but there is no ceiling to how much you can invest in a bank. No problem. You can invest, but again, you have to pay your taxes. Whatever taxes have accrued, that is something that you will have to pay from your sale of property.
Yes, ma'am. And is there any CGI account kind of account which need to be opened? Is there any account?
For what? For this month?
CGA account. CGA account.
Did the bank tell you this?
No, actually I've searched on the internet regarding that, what exactly we done. So there it was mentioned you can open the CGA account.
Shilpa, let me find this out because I don't know if the new rules have come in, if rules have changed. When I was in the bank, it was not required. Please give me a day's time. So after this training and after my session today, I'll just find it out and I'll inform ma'am. Let me just find this out.
Yes, because even I have read that if you sell the property and the amount when comes into your bank account, no, they gives you 2 years time duration where they will not pay any kind of, means we don't have to pay any kind of tax for the 2 years.
Yes,
yes. Is it there?
Yes, it's there. But ultimately, if you want to save taxes, you will have to invest in 54 EC bonds.
Okay, the same one which you are telling.
Yes, or else you will have to buy another property.
Yes, so immediately we can't buy, right?
No,
so
that's why you get the 2 years time. No? That's why you get that time.
So in that 2 years time only we have to.
Yes.
Okay,
You have to. Otherwise, you will have to pay taxes.
50 lakh investment, right?
Yes, up to 50 lakhs. That's a maximum. So say you sold your property for 1 crore. You can't invest that entire 1 crore in 54 EC bonds to save tax. You can invest 50 lakhs. The remaining 50 lakhs, either you pay tax or you buy another property, whatever.
How about insurance or like term insurance or something if they invest into?
No, you can invest, still you have to pay tax because you are not paying tax, or you are paying tax on your previous investment. You are paying tax on your previous profits. So you still have to pay tax, and then after that you invest wherever you want.
Okay, only the thing is that 50 lakh, as you said, we can have a taxable amount for 50 lakh.
Yes. In 54 EC bonds, your limit is 50 lakhs.
Okay. Thank you, ma'am.
Right.
So I think we have extended the time for you, right?
That's okay. Any other question? You can still ask. I still have some time.
Okay, that's great. So it was quite an interesting session, I think everybody was interacting quite well.
If you have 5 minutes of time, let me see if I can show you one calculation in Excel. Can I do that?
Sure.
So I'll just show you the calculation. So just give me a minute while I open the Excel sheet. So I just want to show you something. So I was telling you about the effect of time. I just want to show you that. Okay, just give me a moment. So I will be using certain formulae over here.
Okay.
Just to show you the values. Okay. If you want to learn financial mathematics, we can again have a separate session, but I would just like to show you the effect of time and what is meant by opportunity cost or cost of delay. What happens if you delay your investment even by 1 year? So hota hai na, aap sochte ho, where's the hurry? Today is just 5th of April. The financial year has just started. So I have time till next year, 31st of March. Typical, mentality of investors. So where's the hurry? So I can delay my investment.
Last moment planning.
Sorry?
last moment
last moment planning, or ठीक है कोई बात नहीं, next year you know in the last quarter suddenly the family wants to go out on a holiday, ठीक है चलो इस साल invest नहीं करते हैं, let me spend this money, let's go on this क्या सब होता है ना luxury cruise and all that, let's go over there, blow up the money, you know, the investment can wait for another 2 years. Typical I mean ये investor का mentality होता है. So people said, ma'am, who knows, who has seen next year, I may die this year, then I want to ask the question that what if you do not die, what if you live, who's going to take care of you, who's going to give you the money? Okay, so it's like that, that's typical investor mentality. But I would just like to show you what is the kind of effect time has on your investment. Okay, so I'll just use some formula over here. I'm not going into the details of explaining it to you. So I'll use a calculation called future value, where say any decent mutual fund, of course, these have to be well-researched funds. You will have to take the advice of investment advisors, will earn a 14%. Okay, so I'm taking the rate of interest to be 14%. I am taking time of say 20 years. So if you are in the age group of 30 to 40 or younger, you can very easily think of an investment for 20 years for the purpose of financial planning. It could be fund for your retirement. Okay, it could be fund for your maybe child's marriage. So my child may be 2-3 years old now. So by the time she is 22, 23, 24, 25, she'll get married. So I want money for her marriage or whatever. So say your financial goal is to be realized after 20 years. Okay. And every year you have around say 2 lakhs to invest. Okay. So 2 lakhs to invest every year means if you divide 2 lakhs by, let me make it 2,40,000. So which means 20,000 rupees per month, right? That is what you invest. Or should I make it a little less? 1,80,000, what do you say? 20,000 is too much? Or let's see.
lesser.
Lesser, little lesser. Okay, sure. So how about taking a 1,50,000? Because anyway, to avail tax benefits, 1,50,000 is the minimum that you have to invest. So I take it as 1,50,000. So again, this is a calculation I tell my clients, देखो अगर tax नहीं बचाते हो, ये पैसा आपका waste होता है. Okay, so 1,50,000, right? This is what I will invest for 20 years in a mutual fund where the CAGR, average rate of return, is 14%. See the kind of money that you make after 20 years. It's 1 crore, ignore the dollar sign because the currency has been set to dollar here. So even if it is rupee, the value will be the same. Okay, it is 1 crore 36 lakhs 53,000. Okay. So देखिए 20 साल में मैं करोड़पति बन सकता हूँ. बस मुझे ये 1.5 लाख रुपया 80C में सेव करना है कोई LSS में. Have you seen?
Yes.
Okay. So see, one financial goal is taken care of. So maybe your retirement to some extent. 1 crore 36 lakhs after 20 years, I don't think will make much of, will make a very huge fund because you have inflation over here. आपको 6-7% inflation लेना है. तो 14% return से 6-7% inflation अगर subtract करोगे, so your overall rate of return boils down to around 8%. So that is why we say invest as much as you can. But look at one difference. If you start early, if you are of age 30, and if you start this very investment of 1,50,000, if you continue till the age 60, because 60 is generally the age at which you retire. So here, say for example, I started at 40 years of age. Okay, age was 40 years. I invest for 20 years, 1,50,000 rupees. The other example that I will take is I start at age 30 years and I will continue this till my retirement. That is till 60. Here also I will take the rate to be 14%. In fact, the longer the time horizon, more easy it is to achieve this rate of interest. Okay. Here I have 30 years of time because I started early and I am still investing 1,50,000 rupees. See the difference in the corpus. It's 5 crore 35 lakhs. Have you seen? What a huge difference it makes to your corpus just because you started 10 years early. That is the effect of time on your investment. So just by delaying your investment by 10 years, see the difference in the corpus. Here it is 5.5 crores. Here it is 1.5 crores, a difference of 4 crores. Have you seen? That's the effect of time. So this is what we say opportunity cost, or you can also call this cost of delay. So, when my clients say, Kovina, kya jaldi hai? I'll start 2 years later. You want to know what type of a difference it will have on the corpus, even if you start 2 years late. Let me show you. So here it was age 42. I will show you another example where the age of the person, here it was age 40. I start 2 years later. That is, I start when I'm 42 years of age. I will still retire at 60. So now I have 18 years of time in hand. Let me show you the difference. So this is what formula is telling me. Go to any financial expert. The calculation will always give you the same results. Okay. 14% is what I'm expecting. This time I just have 18 years of time in hand. I started 2 years later. The same 1,50,000 rupees. See the difference. It's 1 crore. It has come down by 34.5 lakhs. So you delayed by 1 year.
Yeah.
आपने इस 1.5 लाख रुपया को, maybe you have used it for some holiday or whatever. So client is happy. 1.5 लाख रुपया इस साल के लिए तो मेरा बच गया, मैंने invest नहीं किया. पर आपका overall corpus सीधा आपने देखा, there's a difference of 34.5 lakhs in the final value. So that is the impact of time on your investment. So you just save 1.5 lakhs this year, next year 1.5 lakhs. आपने 3 लाख रुपया कम दिया investment में. But see the difference in the corpus. That's the effect of time. So I always say, sir, आप देर करना चाहते हो, आप देर करो. You can delay your investment. It's your money. But the end product, the final value is going to come down by 34 lakhs. That is something which is called the cost of delay. Okay, right?
Ma'am, I have one more question. Can I ask?
Sure. Please.
So if I invested in mutual fund, whatever interest they told me, the same interest remains till the end, or it gets changed?
No, mutual funds are linked to the market. Okay, they are linked to the market. So the rate of return will vary. However, that is why I said, if you stay invested for a period of over 5 years, आप अगर 5 से 10 साल का time horizon लेके चलोगे, a 14% is a very, very decent rate of return. However, I cannot give it to you in writing. It is something like, ma'am, what is the price of gold today? What is the price of gold? 10 grams?
It's 51,000
rupees. Okay. What will be the price of gold after 10 years?
I can't judge
exactly. But you know that it's going to go up, right? You know that?
Yes.
You don't know
it may go up or it may come down also.
It's never come down, ma'am. Over a period of 10 years, just check the price of gold.
Okay.
Not in the last 300 years. It's not come down. Okay. So you will not be able to.
Tesla starts going to the space, it can come down.
Okay. So you will not be able to tell the exact value of gold 10 years from today, but you know that it's going to go up. I say the same thing about mutual funds. I will not be able to guarantee you the rate of return, but I can tell you that you can very comfortably expect a 14%. But if you tell me exactly how much I will get, I'll not be able to tell you. Something like that. Right? So there was another question, that is, if you start at 53, so let's take another example where my age is 53 today. So I will still keep the rate at 14%. I have another 7 years. this is what you can get. This is what you can expect. 16 lakhs. But yes, the rate of return can be increased. So we can have a portfolio for you. There are other investments also which give higher returns. But again, as I said, higher the risk, higher the return. There are different types of mutual fund schemes also, right? So again, depending upon your requirement.
Also, I think, Kanina, if the investor is capable of investing more funds, like because
yes, that's the other way. That's again the cost of delay.
Yeah. So
if you want to achieve the same corpus, then you have to invest more. You have to invest more.
But the duration is less, so definitely the benefit will be
absolutely,
more.
Absolutely.
Yes.
So the cost of delay is either invest the same amount and get less fund at the end, or the other is invest more to get the same amount of fund. However, that's the opportunity cost that you pay.
And even we have a wealth and assurance, like, plans and term insurance, like where you can plan out something for your goals.
Yes. So there are a lot of other options. So that's why I said it's individualistic, not possible to, give you an exact plan right now, because there are so many things I need to know before I can suggest something to you. So that is why it's better to connect one-on-one. Ma'am can try and understand what your requirements are, and then, IIFL and AMG invest together. We can work out a plan for you. But believe me, if you start early, even with a small amount of investment, you can realize all your financial goals, everything, whatever, just by starting early. Right? So we have, as I said, we have different portfolios, we have different models. We just need to understand what your requirement is. What is the reason why you need this money? The reason why I asked that is, it is just not enough to invest. So, I'm showing you that you will get 1 crore 36 lakhs. But then again, I said after 20 years, 1 crore 36 lakhs will not make much sense. This is something what is important. So I invest, at the end, I get a certain amount of money, but at that time, will that money be enough for me? So that is also that needs to be worked out. So that's why I said, why do you need this money? Is it just for creating wealth? Is it for your child's education? So after 20 years, will 1 crore 36 lakhs suffice? I don't know. Okay. Is it for your retirement? If it is for your retirement, this is definitely not enough. Okay. So we need to know why you need this money. What is your risk taking capacity? How much time do you have in hand? And then based on that, we can work out a plan. Right? So it's going to be very individual. Your plan will not suit me. My plan will not suit you. Right? So very, very interesting, So even with this very humble start, how you can build a big corpus for yourself. So as I said, the only magic that works here is time, nothing else. Only magic. Okay. So you have to give time to your investment, stay invested, stick to a single investment advisor. It's like, sticking to the same doctor who's been doing your treatment maybe for the last 10 years. So he knows your history. He knows what suits you. He knows what doesn't suit you. So he will be able to do your treatment properly because he has all the information. So similarly, you must stick to one investment advisor who has been planning your investments from the very beginning, and try and start as early as you can. Start with humble amounts. Start with very decent amounts. You want to give it a try? Start with 5,000 rupees a month. But do not delay because you are losing out on opportunity. Right. Any other questions we have?
No, I think.
Okay. Because this is something, I find that people are always very interested in financial mathematics, especially when I go to teach my CFP students, when I try to teach them financial mathematics, it's always like, ma'am, can you work this out for me? If I invest this, what will I get? So it creates an interest.
That, they have that idea earlier.
Yes.
Our case is like we realize it much later, like, like then we will be in a hurry. Where should we start? How should we start?
Yes.
So mainly with the women, women will forget when to have their own investment planning.
So it was like 2 years ago when this pandemic started. So I was doing a session for housewives. So they all get pocket money, right? So I used to tell them, how much can you save in a month from your pocket money, even if your spouse doesn't give you more. So how much can you save? So whether it's 500 rupees, 1000 rupees, put it in a proper investment vehicle. You'll make money out of it.
Yeah.
So
That's good. It's a very good, idea, like, so that people will start having that saving mentality right from the beginning.
yes, yes.
So
So
they will-
instead of putting that money, in a piggy bank, ya chawal ka dabba, okay? So put it in an investment. You'll always make money.
Yeah. Thanks a lot, Sunina. It was really wonderful, and we never
Thank you.
thought of the session has extended quite long, but so that it was really informative,
Thank you. Thank you so much.
Looking forward to have much more informative session, like as you said, the financial, calculations. These are the things that will definitely help us, to
Right,
have insights into how what amount should be invested where.
right, right.
Yeah.
Right.
Right kind of investment. So
Correct.
anyway, thanks a lot, and thank you all.
Thank you. Thank you so much. Even I have to rush to another session now.
you.
So thank you so much, ma'am. Thank you everyone for your participation. Bye-bye. Take care.
Bye-bye. Take care. Bye.